Paul Sion, Realtor with United Real Estate Home Connections, licensed in the state of Ohio and Kentucky. With me today is Angie Hoffiman with U.S. Bank. Angie, how are you today?
I'm doing great, Paul. How are you?
Great. Thank you for being on my podcast. So we're going to start off today. Today's topic is commercial lending. Angie is a commercial lender with U.S. Bank, as I mentioned. So Angie, why don't you tell us a little bit about your background, what you do with U.S. Bank, and how did you get started in that field?
Sure. So I am a Cincinnati resident, have been my entire life, and was previously with a company called the Connor Group, which is located out of Dayton, Ohio. They're a private investment real estate firm. I was with them for about 5+ years. Just learned a ton of information, really loved the financing portion of, their group. And so that turned me to the banking portion, which I ended up going with U.S. Bank just because of the knowledge and the breadth of what they can do as well. And just the culture, within U.S. Bank has been phenomenal. So I've actually been with U.S. Bank now for 5 years. In the last 3 years, I've been within the commercial real estate side as well as the business banking side.
Okay. And your primary focus is commercial loans?
Correct, yes. Both investment real estate as well as owner-occupied and small to medium businesses.
Okay. On the investment side, I represent a lot of buyers of multifamily. And so I know with 4 and below, we do, in the conventional space generally, and then when you're in the five units and above, we go into the commercial space, which is your space. I've heard of it being covered with mixed-use buildings, industrial properties. Is there something else that commercial loans would cover?
Correct. So, it can really be, quite an array of properties. Office is one that we see pretty often and can tend to be either, hot in certain areas, whether it's office class B or office class A, retail strip centers, we'll look at triple net properties and absolute net properties, are very popular. If you're looking at diversifying a multifamily portfolio and adding in some triple net properties, we also do obviously owner occupied properties too. So, when you have that small business or medium business owner who wants to own their own real estate, we do that as well. And that's, again, part of what, my position entails. And then, we will also look at portfolios. We'll do single family homes. So I'm actually working with somebody now who has a portfolio of several single family homes that we're looking to kind of restructure and refinance for him. And we can even utilize current equity in properties to purchase, additional properties to help you grow your portfolio. So we do try to have a full understanding of your portfolio, a full understanding of what your strategy is, and then, help partner with you, as you continue to grow that portfolio, short and long-term goals. Okay.
For our listeners who don't know what triple net means, do you mind explaining that?
Sure. So triple net is going to tend to be your properties that have the tenant itself is paying the taxes, the insurance. You may have some pretty minimal, depending upon the property, responsibilities that are usually restricted to the exterior of the building. It may be like a roof or a parking lot type of maintenance. But generally speaking, the great thing about the triple net is that for some clients, it's a property that you can, basically own and you have to do pretty much nothing with. And then you're gaining that, that income without having to do very minimal type of responsibility or maintenance. The downfall of that is that typically they're going to be somebody, who is going to be a longer term lease, which is great. However, you still have the issue that it's a bigger square footage generally, so 5, 10, 20,000 plus square feet. If you lose a tenant, obviously that can be very impactful. So it just depends upon your focus of your portfolio and if you want to add in that, but it can be, great opportunity, but tends to, again, be a little bit less of a return because of the minimal responsibility.
Okay. Going back to the single family, you mentioned you could do it. That's similar. I don't know if I'm using the same term your bank used, but a wrap mortgage. Is that what you're using for single families?
So we do have the ability, from the perspective of what you say, wrap mortgage, we're typically calling that like an umbrella. If you're grouping all, let's call it, if there's 10 single family homes and you're grouping those all into one loan, collateralized together, we have the ability to do that, depending again on the structure that the client is looking for. We also have the ability to separate out those facilities and do a simultaneous closing for each one of them to have them separated out from each other. Obviously, there's some contingencies with that the properties itself have to be able to cash flow by themselves, things along those lines that we would underwrite to, but we do have the ability to look at it from both perspectives.
Okay. The biggest advantage of that is when if somebody's reached the maximum 10 conventional mortgage loan limit, they could step into your space there and you could cover them and they could either restart that or, continue
Correct.
on with something like that too. Let's say somebody does get 10 properties, and are they able to finance in additional properties into that same loan, or is it a refinance each time?
No, we would be able to add in. So, I mean, if you're asking like if they want to refinance these properties and they're also looking to maybe either use some of the equity in them or they're also buying at the same time,
Yes.
we can do all of that together.
Okay.
So that's not an issue at all.
Okay. And let's say somebody's new coming to the investment. What's the typical down payment on commercial loans if they're looking to buy in the mixed use space or multifamily space?
So generally speaking, we'll go up to 80%, loan to value. The biggest factor within that is going to be how much the capability of the property to hold that debt. So we're going to have, and we have a pretty, I don't want to say complex, but we do have, multiple factors that go within our cash flow and net operating income calculation that we're going to want to see it balanced to a certain point for it to be able to hold the debt at an 80% loan to value. And again, we tend to partner with our clients. I have several clients who will send me properties on a daily basis that they're interested in, and we'll let them know what the debt, capacity would be on that property.
Okay, so you're considering the income from the rents per se, like let's say somebody's got a 10-unit building, and then you're looking at the rents that are coming in. You're also considering the buyer's income level, income to debt ratio, and all that as well.
Yes. So we're, when I talk about the capacity of the debt for the property as being one of the first things we look at is in order to get to that 80% LTV, if you're looking at the actual debt they're wanting the property to take on compared to the rents they're taking in and the expenses, as well as some vacancy factors, things like that. That's what we're looking at to have a certain ratio. And then on top of that, when we get to the next step would be look at the client globally and, their personal debt to income and that factor too.
And looking at that, the commercial mortgages as well, is that can a buyer use the mortgage to upgrade property to, build in some equity into the property? And does the building in of the equity get taken into account? And do you have a loan that allows them to do that?
So that question is kind of twofold. So if you have a property, let's say it's multiple unit and you're continuing to kind of do some improvements and renovations, if the property has the equity, we can look at small lines of credit to help with that renovation cost, and then once everything's completed, be able to wrap that together. If you're looking at a property that's completely distressed and doesn't have any type of income, then that's going to be something that generally we're going to have a harder time with because it's a speculatory type of scenario, and we want to typically see the actual income.
How about converting something? Say I'm interested in buying a warehouse and I want to convert it either to retail space or multifamily. Do you offer products for that, or is that a similar situation where you're looking at the risk as being a little high?
Yep, so that is going to be a similar situation. Once the actual project would be completed, again, from a speculatory standpoint, it becomes a little bit more difficult from a risk perspective. However, we've been in scenarios where we've worked with clients and partnered clients with people we know who work in that space more than we do. And we can look to, guide them to what we would look at if we wanted to refinance that once it was completed and there were leases in place.
Okay, so that's one of the benefits of working with a big bank like U.S. Bank is you can reach across departments there and tap other resources within your organization.
Yeah, even if it's, within the organization, we can, we have other resources, whether it's our private wealth or wealth group, have some capabilities that are different than what we, have, as well as from a, COI or network basis, it may be somebody just within my network that I know works within that space to, introduce that way and hopefully can, get that client taken care of.
Okay. Are you able to comment on the underwriting process of commercial loans compared to residential? I mean, is there a big difference in the underwriting process?
So yes and no. So I know we touched on it already a little bit. One of the biggest differences is obviously we're going to look at the actual collateral in a very different way, especially on the investment real estate side. When you're looking at investment real estate, the factors of the net operating income as well as the cash flow of the property become factors. Whereas when you're buying a home, obviously it's a lot more about the loan to value of the property. However, on the other side of that, if we are looking at a property that's going to be owner occupied by a small to medium business, it becomes a lot more about the loan to value as well. So it can depend upon the situation.
Okay. And how important is a person's experience when they come to get a loan for you? If it's a new first-time investor looking into multifamilies versus, somebody who's already got 5 to 10 units and been either self-managing or running it for a couple of years.
So, generally speaking, if you have somebody brand new, one of the biggest things is if you're not familiar in the scope and you don't have experience, are you going to be partnering, potentially with a property management company or somebody else who is maybe a partnership within, the LLC or the property that you're buying that has the experience, just being able to show, you may not have previous experience in this, but you are partnering with a property management company that has, historical success in these properties, or you're partnering with somebody, for instance, who has historical success in the properties.
So it boils down to your team then that you're bringing to the table.
Mm-hmm. Yes.
Okay, great. And what kind of document requirements are there to start a commercial loan process with U.S. Bank?
So generally speaking, and every situation is different. Every request is different and client is different, but it's typically going to be 2 to 3 years of taxes, personal and business. Personal financial statements, pretty standard as well. If it's a purchase, we're going to want to see a purchase agreement or understand the purchase agreement, as well as you're going to want to have financials, whether it's profit loss or the rent rolls, preferably a Schedule E or 8852 from the client, showing what the historical, trends of that property have been. And again, that's where we really try and partner with our clients of understanding their portfolios, understanding what purchase they're trying to make so that, does it fit? And is there anything, we see, because we see them on a very regular basis, that maybe we need to discuss or let the client know that we, are suggesting maybe prying a little bit more information.
Okay. How important is one's credit score when they come apply for a loan with you?
It is a factor. In any type of, just like the traditional mortgage, it is going to be a factor. But there are so many different factors that, it's only one of many.
So one of the important things when it comes to purchasing real estate is I always tell the buyers is have a pre-approval letter ready. Is there something similar in the commercial loan space, a pre-approval letter, pre-qualification letter, just something that says, hey, somebody sat down with you, they've started the initial process, they've got access to a certain amount that they can borrow to purchase this property. Do you have something like that?
We do. So on the commercial side, it's going to be called a letter of interest, and it basically lays out that we are working with a client. We have a price range or up to a price range that we're looking for with the client, and depending upon the collateral. So we are looking to work with him on the financing, again, depending upon what the collateral is. And then we also have, once we've actually maybe gone through a more official process of underwriting and submitted an actual financial package, we do have, depending again on what the financing contingency is for that client, we do have a letter of commitment which lays out that there is an approval, but it goes through all of the conditions as well, like your appraisal, certain things like that we're going to have to clear.
Okay. And how long does that process take? If you were writing an offer today for a client, and then usually you have to write in how many days we're going to close in, 30 days, 40 to 45 days. I know conventional, it's usually a little quicker, a little easier, so we can do it in 30 days or so. what would you recommend for a commercial loan?
So I think 45 days is very practical. One of the biggest things that I always talk about with my clients is that, that 45 days really is incumbent of me having a full financial package, meaning those 2 years of tax returns, the financials I spoke about from the client that you're purchasing and or if you're refinancing. So me having that full financial package is really, the key. And then, again, from there, it's going to be some of the factors of the appraisal as well as the title work that would go along with it. But generally speaking, 45 days to close is pretty
reasonable.
Yes.
Okay. That was actually, you mentioned the documents. That was my blog article from last week talking about the documents for the conventional mortgage process. You mentioned W-2s, 1040s, tax returns like that. Is it pretty similar, the document requirements for commercial loans, that it is for in the residential space?
Yes, it's very similar. With the PFS is going to be one of the biggest, as well as the 2 years of tax returns, potentially 3 years depending upon, again, the request size. And then, like you said, if they're a W-2 income type of employee, then we may need additional pay stubs. Like I said, for any client, it could be very different depending, again, on what their history is. If they're a business owner, then we may need some more details. But generally speaking, again, it would be 2 to 3 years of personal business tax returns, personal financial statement, and potentially, obviously, purchase agreement or additional documentation from that side.
Okay. And then when it comes to partnership, people coming together, you need those documents from everybody, correct?
Correct. So depending on what the ownership structure is, generally if somebody is over 20% ownership within the property, then we're going to need that financial information from them as well.
Okay. And I know with the conventional space, lending into an LLC is generally impossible. Most lenders will not allow conventional borrowers to use an LLC. How does that work on the commercial side?
The vast majority of the lending that I do is going to be through an LLC, in a holding company. The clients are still a personal guarantor, but the lending itself and the title is all within the LLC.
Is it a requirement to be an LLC, or is it an option for the buyers?
It's an option. I mean, one that, again, depending from an attorney's perspective, if you're talking about liability, it may be a best case scenario to have an LLC with that property, but we always reference to talk to your attorney about what makes sense for you.
Okay. And how much do you have any minimum loan requirements and your maximum loan requirements?
So we will up to $10 million on the investment real estate side. And then once it's beyond that, we do have a commercial group that we would work with, a real estate group, as well as our middle market group that would potentially be involved. And then as far as minimum, typically, again, if it's under $250,000, it's still something that we would do. We pull in a different partner to work with us on that too, because it kind of goes into a little bit different of a space.
Right, so is there, you say under 250, is it like, for argument's sake, $250,000, or is there a lower minimum? I know with some conventional lenders won't touch anything 50,000 and under.
It's pretty common, yes. Under 50,000 is going to be a little bit more difficult.
So generally, a 50,000 to 250,000 is that, and then above that, then it steps into your space then.
Mm-hmm. But keep in mind too, I mean, if you have properties itself, it may be, again, you see this more with the single family home portfolios, you may have multiple properties that are under 50,000, but we're looking at the entirety of the portfolio, makes a little bit different of a scenario. So, I would caution that, anything that somebody's looking at from the perspective of either total lending amount or even individual property, we're happy to take a look at it and have an understanding of what you're looking to do. And if for some reason it's not something that is in our world necessarily, again, from an internal and external standpoint, we typically have somebody who I can contact.
Okay. And discussing interest rates from a general perspective, obviously everybody's situation is different and unique, but in terms of, paying more, having a lower LTV, a 60% LTV rather than 80%, can people get themselves a better interest rate, or is it generally going to be the same and more just dependent on, credit and history?
So from an interest rate standpoint, the commercial side is a little bit different than maybe the mortgage or lines of credit side than you generally see. So ours is based off of what the bank's cost of funds are, and then there is a spread that is on top of that, and that's where you get the percent from. Right now, cost of funds are pretty minimal, so interest rates are extremely competitive. But from that perspective, it doesn't necessarily factor in the actual loan itself or the guarantor itself or the property itself.
So there's some risk-based consideration towards interest rates as well. I guess a little higher risk project, is that something you would price a little higher on the interest rate, or generally that it's not considered as much?
No, that's not considered as much generally.
Okay. Great. That's all the questions I have for you today, Angie. Did you have any final thoughts to share with the group?
Sure. So, one thing I would say is if anybody has any questions about, property specific cash flow, if this property may fit into their portfolio or something that we would look to lend at the up to 80%, I'm happy to partner with anybody on that side as well and be, a resource for them. And then on top of that, I did want to mention that, obviously U.S. Bank is across the country, and that gives us the ability, even if I'm your contact in Cincinnati, to lend out-of-state borrowers. So I've worked with quite a few clients, obviously from California, that are buying in Cincinnati as well as Chicago. So those are people that I've worked with quite frequently as well.
That's perfect too. I've got a number of out-of-state clients too, and that's one of the big questions that I have, big challenges, I guess I should say, that I face with some of the local lenders, is that they don't lend out of state. Yep. But that's a great ability to have.
So the key within that too is just, as I want to mention too, anytime that scenario comes up, we're happy to discuss it. One of the biggest factors with out-of-state lenders is that we do look for them to be within a U.S. Bank footprint. So we are very much on the West Coast and Portland, all of those areas. If there's somewhere you're not familiar, if we're within that area, please reach out, let me know, and I'm happy to take a look.
Great. Thank you again. I will leave your contact information on my blog post once it gets published live. Thanks again for being on the podcast.
Thanks for having me.